The EV material space keeps rolling with another big M&A, and the world's largest jewelry company tells the diamond miners to drop dead. Welcome to Kitco Roundtable. I'm your host, Michael McCrae. Editor Neils Christensen is in. Hi, Neils.
That's a crazy way to start this roundtable, but happy Friday, everybody. That was pretty harsh.
Kitco correspondent Paul Harris. Hi, Paul.
Hey, good afternoon.
And if you're listening to this, you probably know all about ESG and carbon emissions and miners trying to be green. It's the main reason why Pandora Jewelers and the diamond miners are no longer working together. Our next guest is trying to solve the difficult problem of third-party verification and carbon emissions. It's Mark Fellows at Skarn Associates. Hello, Mark.
Hi guys. Thank you for having me on.
Mark, what is Skarn and what do you do?
So, Skarn Associates is a research business that we really created 12 months ago, and our background is as mineral economists. So we're career mining analysts, but we decided that ESG and the way that that's measured really needed looking at by a bunch of guys who understood how a mining operation works, because we felt that right now the way that ESG is looked at, it's very often looked at by the same people who look at policy and governance and all of those things, and not necessarily people with a technical background. So we're looking at particularly things like carbon emissions and water usage from a very operationally literate mining industry perspective, quantifying those things and benchmarking them, and using that as a means to kind of measure mining companies' progress in terms of reducing their environmental impacts. And that's what we do in a nutshell.
We are going to talk ESG, carbon emissions later in the podcast, but first we start with the metal of the week, copper. The metal hit an all-time high today. Reuters reports that 3-month copper at LME hit $10,232 a ton. Niels, in your Bank of America write-up earlier this week, the bank had copper at $13,000 or even high as $20,000. The bank noted LME warehouses are at a lowest level in 15 years, and that added stocks could currently cover only 3.3 weeks of demand.
So Bank of America, they see a supply deficit of 186,000 tons for this year. That's going to double next year. They say that the only thing that's really going to save the market right now is recycling. And if recycling in the copper market, that secondary market doesn't come through, then prices could go up as high as $20,000 per ton. So it's fascinating. This supply crunch in the copper market is just amazing.
There was an article in the FT today in which Glencore, the head of Glencore, said the copper price needs to go up another 50% for supply to meet demand.
Wow.
The International Copper Study Group is taking another side of that. They're forecasting that global refined copper surplus of about 80,000 tons. That's a slight, how would you say, that's a slight surplus, but 80,000 tons for 2021 and 111,000 tons for 2022. That's primarily due to an end to supply disruptions and several new major mines that are coming online to add to the supply. Friedland's massive Kamoa is expected to start production within the month, and the ICGS is listing about 5 major copper mines altogether that are going to be starting this year. Niels, there was also a jobs report.
Was there? I don't think a lot of people want to talk about the jobs report. So this is the fascinating thing about economics. Economists can say whatever they want and there's no repercussions. They were expecting 1 million jobs to be created. Some estimates were as high as like over 2 million jobs to be created in April. We got 266,000 jobs created last month. So it's the second biggest miss in estimates in the report's history. So this just like this, like everybody heading into this report, everybody's saying, the economy's on fire, building up full steam, employment's racing back, everybody's getting jobs. there was even talk of, the market overheating. I mean, Yellen, sort of she outstepped her bounds on Tuesday and said that, the interest rates might have to go up to stop the economy from overheating. She did walk some of those stuff back, but I mean, she's saying what a lot of people are thinking, that, the economy is overheating, and we might have to taper as early as the end of this year. That's kind of gone off the table. And this is why we saw gold up. Gold's ending the week with, 3% gains. Best week this year, best week since early November. And yeah, right now there's not a lot in the way for gold market. I think we're going to start seeing markets pricing in higher inflation and lower bond yields, and that means lower real yields.
Help me out with that again, Neil. So we did have the move to the higher for gold, I think about midweek or Thursday, when it kind of broke out decisively out of the 1800 range. So what is the story going forward? So if we have a weak jobs report, there will not be inflationary pressures. So what are they accounting for in terms of precious metals going higher?
Well, actually, I think there still is inflationary pressures. The wage growth in the employment report actually increased 7% month over month for the year, up 0.7%, up 0.3% for the year, and that's part of it. Some people are saying that American workers are staying home because they get more money for going on unemployment insurance than they are working, and that's causing this labor shortage. So wages have to go up. But I do think, what this employment does, it's sort of the opposite of, yes, it's not super inflationary, but inflation is coming. We saw this week, both manufacturing and service sector data showing inflationary pressures. Input costs are rising. That's going to eventually trickle down to the consumer. And, so inflation is there, but what this really does is it relieves pressure on the Fed that they don't have to tighten anytime soon. So, I mean, this is what's going to happen, so everybody was expecting, okay, 1 million jobs. This is just the start of a big domino effect. And, they're going to have to set it up at Jackson Hole in August, that they're going to start tapering by the end of the year. This was the narrative that was happening as early as on Tuesday, Wednesday, even Thursday. Inflation was heating up. The economy is heating up. That completely came off the table. Some people are still saying, well, this is an anomaly. By the time we get summer, we're going to start seeing jobs pick up again, and all of this stuff. I don't necessarily know. Yellen actually came out this afternoon with some interesting statistics. She said that 2 million women have left the workforce because they can't afford childcare services. So you're not going to get a lot of people going back to the work if schools aren't open, if they don't have daycare for their kids. They literally can't afford to work. Daycare costs are so expensive that it's cheaper just to stay at home. So a lot of people are actually saying maybe we won't see the job growth until September when school gets back in. So, I mean, now we're heading into the summer. Are we going to have day camps? Are we going to have, summer camps? What happens with the pandemic? So it's the labor market is definitely in an influx, and economists just don't really know how to price this all in, which is really interesting. And I think you're going to get a lot of volatility going forward between estimates and actual forecasts and the actual data.
Now I'm going to guess we had a good weekly gold survey.
Yes. So again, 3 weeks ago, no bulls or no bears in the marketplace. Last week, no bulls in the marketplace. This week, no neutrals in the marketplace. No fence sitters. But yeah, we had 14 out of 16 analysts surveyed So 88% are bullish on gold for next week. That's, I think it's 75%, 76% of retail investors are bullish for next week. Interesting though, so gold has seen a really solid breakout, healthy breakout above 1800. The only problem is that there's going to be lots of resistance between sort of 1830 and 1850. A lot of people I've been talking to say, gold's 200-day moving average comes in around 1851. That's going to be a big level of resistance. If you want a really good momentum trade in gold, you really have to get above that. So what we could have done is entered maybe a new trading range. Maybe for the summer we consolidate between 1850, something like that. Maybe even 1750 and 1850. Who knows? There's definitely strong renewed sentiment in the marketplace. A lot of it because of inflation. You had a really interesting story. Sam Zell, billionaire investor, he's actually buying gold for the first time because he wants that inflation hedge.
You can find the weekly gold survey on Kitco homepage. We run the Kitco weekly gold survey every Friday. Let's turn to exploration and developers. Paul, Colin Cattell's Newfound Gold is on quite a run.
Yes, Newfound Gold put out their best drill intercept to date at the Keat Zone, its Queensway Gold project in Newfoundland in Canada. That's seen the company's market capitalization pass $1 billion Canadian. The stock rose about 8% on 2 consecutive days, taking its valuation up to $1.2 billion, as the company reported an assay of 17.7 meters grading 124.4 grams per ton. The company has a 200,000 meter drilling program underway at Queensway in what it believes is a deposit that bears similarity to Kirkland Lake Gold's Fosterville mine in Victoria, in Australia. And the drilling at Queensway is also lifting the stock of its next door neighbour, which is Labrador Gold, which is now has recently hit a 52-week high.
I reached out to Colin, emailed to say that the Queensway project was acquired in early 2016 following a trip to Newfoundland by himself and co-founder Denny Laviolette. And we've had Denny on the show before. Denny, of course, is involved with Goldspot, who has been featured by Kitco. And then Colin has also worked with Kitco with his Palisade Global. Over the next 3 years from the 2016, Colin emailed to say that him and Denny raised several $1 million, applied geophysics to it. The company's first drill hole was in 2019. And then you've had the IPO, and the company's market cap is now in excess of $1 billion US dollars. That just shows how these things can kind of hit, and they can kind of hit quickly in this business. BlackRock continues to expand its Tonopah West, Paul.
Well, I would have said Tonopah West, but there we go. BlackRock Silver intercepted a high-grade gold and silver step-out drilling there at Tonopah West, which is in the Walker Lane district of Nevada in the USA. And this struck me as one of perhaps the most eye-catching intercepts this week. Highlights there, 1.5 meters grading 16 grams per ton gold and 1,722 grams per ton silver for 3,322 grams per ton silver equivalent. So, good going there for BlackRock.
What happened at Marimaca?
Marimaca Copper is one of the more exciting copper exploration development stories in Chile. Their stock has gone up considerably over the past 12 months, corporate turnaround, new management, all of those good things. Recent drilling has extended mineralization below their Marimaca copper oxide deposit, which is near Antofagasta in Chile. Drilling intersected down dip and long strike extensions. The highlights there are 38 meters grading 0.3% copper and 106 meters grading 0.39% copper.
Why is it interesting, Paul, that AngloGold Ashanti upped its interest in Jeffrey Pontus's Carver's Gold?
Well, ever since I first spoke with Jeffrey about the project many, many years ago, the goal of the company has always been to sell. And it seems that may be getting much, much closer to reality. AngloGold Ashanti entered into a $20 million US loan agreement with the company to fund ongoing permitting and pre-development work at its North Bullfred project in Nevada in the USA, as well as ongoing exploration at the Mother Lode deposit and Linda Strip projects. AngloGold currently owns about 19.7% of Corvus and is exploring the neighboring Silicon project. The company has a 90-day exclusivity period to review Corvus, during which time Corvus will not be entertaining calls or anything from any other potential suitors. Corvus, their executive team contains many former AngloGold Ashanti employees, including Jeffrey Pontus, as you mentioned, but also Executive Chair Ron Largent. And it's also, its work program in recent years has been, one could say, has been aimed at making the company irresistible to AngloGold Ashanti. Recently, it focused on its 2020 Linda Strip discovery, which is a narrow band of land sandwiched between Silicon to the north and Core Mining's Sterling project to the south. Drilling has encountered broad zones of leachable oxide golds with intercepts such as 205 meters, grading 1.36 grams per ton, as well as high-grade vein mineralization. Corvus has also been working on expanding its Motherlode deposit, which is immediately west of Silicon, looking to identify potential new large gold zones at depth. Motherlode has a PEA outlining average production of 171,000 ounces for 8 years. So it seems that the company is coming close to getting an acquisition over the line.
Pandora Diamonds announced Tuesday it will no longer use mined diamonds. Instead, it will use lab-created diamonds. Pandora said it is the #1 jewelry brand in the world with over 85 million pieces of jewelry sold and 26,000 employees. In 2020, the company had $3 billion in sales. The company said that lab-grown diamonds help the company meet its goals for carbon neutrality and ethically sourced materials. The lab-grown diamonds also cost less. Niels.
This is actually really interesting because last year they also announced that they were only going to use recycled precious metals, gold and silver, in the marketplace, to reduce to reduce their carbon footprint. So it's not surprising, but it is like, telling miners and diamonds to take a hike is very interesting.
Well,
Paul.
I think we've got a neat segue into Mark as well, because I can't remember the name of the company, but there is a company out there that's looking at sequestering atmospheric carbon and creating synthetic diamonds from that.
I think also that. Sorry, go ahead, Mark.
Well, I was going to say I just can't. I struggle to see how that's going to be massive quantities of carbon. Unless they're going to be growing very large diamonds and making them very cheap so that everybody can afford to buy them. But, maybe I'm missing something there. I don't know, Paul. I mean, maybe you know a bit more than I do.
Well,
are you going to be wheeling out a diamond the size of a fridge when people get married, and then that will have all your carbon sequestration that will be in that diamond right there? I will say just regarding Pandora, there's a question mark just regarding how many actually mined diamonds they're actually consuming, but it was a notable story, just kind of giving their extreme brand and their large known area in the space. Niels.
Well, I think, and maybe Mark can touch on this, but it shows just how big ESG is playing in the marketplace. I mean, it's more like you say, maybe it's more of just a headline, but the fact is that it's attracting attention.
Yeah. And what I know about Pandora is not that much, but I do know that those guys are really good at marketing. They're really good at placing themselves just in the right position for the people they want to sell to. And they've obviously detected something in their consumer base to prompt them to do this. And we're going to see a lot more of it. But it's kind of like planting trees to offset carbon emissions. There's a bit of a limit to the extent to which you can make progress by doing that if you actually do want to reduce the amount of CO2 in the atmosphere. And it's also quite similar to the idea of using only recycled precious metals. Well, that's a limited pool of metal. Obviously, with something like gold, where you have massive stocks sat in central bank vaults relative to annual jewelry consumption, then arguably, yes, you could, get by for an awful long time if you could release some of that gold. But we all know it's not that simple. And for other metals where recycling rates are already, in some metals it's already quite efficient in terms of the amount of metal which is recycled. And I'm thinking of, say, silver, and gold as well. The recycling rates are really quite high. While markets are still growing overall in terms of consumption, that recycling thing just doesn't work as the absolute answer to these questions.
Going back to the start of your answer, Mark, you are right regarding Pandora being good at marketing, and they certainly did grab the headlines in the major news publications in the middle of the week. Paul, there was big M&A action, and swing back to the EV space.
Yes, it's in some ways it's a similar situation as with Corvus, where a bigger company is suggesting it's going to do a takeout, although it's not there yet. Here, the companies are Bacanora Lithium, which says it's entered into an agreement with China's Ganfeng Lithium regarding a possible cash offer for Ganfeng to buy out the Bacanora shares it doesn't already own at a 50% premium. Bacanora and Ganfeng each hold 50% of the Sonora lithium project in Sonora, Mexico. Bacanora has begun early site work there. They raised about $65 million earlier this year. And the aim of the partners there is to produce between 17,000 and 35,000 tons a year of lithium carbonate, with first battery-grade lithium expected in 2023. Ganfeng has a 50% offtake there, and Japanese commodities trading house Hanwha has the offtake for the other 50%.
There's been a spate of M&A deals in the EV space. The metals company going public, that is the deep sea ocean miner, and its $2.9 billion SPAC deal. In April, lithium miners Orocobre and Galaxy Resources merged to create the world's fifth largest global lithium chemicals company. That was a merger that was valued in Australian $4 billion. I think that's a good place to bring you in, Mark. If I'm an investor and I'm somebody that cares about ESG and I see one of those sustainability reports on a company's website, how do I read it? What information is in there?
Well, that's a really great question. And my response to that is the problem with those reports is that they really lack context. It's all very well a company telling you what its own emissions or what its own performance in terms of reinvesting in local communities, or how few or how many people they're maiming or killing every year in the course of their operations. That's fine. But if you can't benchmark that relative to their peers, their competitors, and the global industry as a whole, it really does lack anything to allow you to say, well, okay, that's good, or that's not very good. And that was really the premise behind our business, was that somebody needed to collate all of these numbers, make sure that they're consistent, fill in the gaps, and ultimately forecast, particularly things which are driven by technical drivers like emissions being driven by energy inputs. And somebody needed to do that in a very consistent way across as broad a spectrum of individual mining assets as we possibly could. And that was really the whole premise behind our business at Skarn. And what we do is we drill down to the asset level. So in many cases, companies will provide you with a company total figure for, say, their carbon emissions or their water usage, but they might not necessarily split that down into the individual mining operations. We go to quite extreme lengths to arrive at the best possible estimates if the companies are not publishing those mine-by-mine numbers. And we've got all sorts of benchmarks and engineering rules of thumb that we use to figure out what the actual energy usage is likely to be, given what we know about the location of an operation, its scale, the mining method, the process method, the hardness of the ore, where does the electricity come from, how big are the trucks if it's an open pit. All of that stuff allows you to essentially estimate with quite a high degree of accuracy, even if the company themselves are not reporting those granular numbers. And obviously, we also reconcile to the corporate stated totals, making sure that our breakdown actually reconciles with what the company's stating as a total. And of course, we speak to the companies. The companies are approaching us, obviously, because our name is getting out there now, and people are very interested in our carbon intensity benchmarking curves. And the first question a mining company always asks us is, can you show us where our operations sit on your curves? And usually the response comes back that we've done a good job. But the whole point is context and being able to benchmark things. And if you just pick up a lone company's sustainability report, it probably isn't going to allow you to do that.
They're always interesting how untethered they are when you see them within a company's news feed, because you're so used to consuming all the financial information and never mind what they're doing on drilling, and then you can just compare all of those numbers. But the sustainability reports, they just kind of sit alone. Paul?
I guess it's only a matter of time. Most investors understand that if your all-in sustaining cost of producing gold is $1,000 an ounce, they have a view on whether that's good or bad. But it's only a matter of time before the community gets that kind of understanding about CO2 emissions. Mark, what metals do you cover? I mean, it's gold, it's copper, aluminum, nickel. What else?
Metallurgical coal, iron ore, and zinc currently. So a big chunk of the commodity space. And we've obviously focused on the metals with the highest market value, the metals which are essentially attracting the most attention from the financial institutions and investors. So far, we haven't tackled the battery metals, simply because in actual fact, those markets are still quite small. But obviously, at some point in the future, we will do. But so far, we've focused on the big markets, and obviously copper and nickel are huge in financial terms. And the other thing is those metals themselves are obviously inputs into the electric vehicle market. And one of the things we're seeing, one of the areas we're getting a lot of interest from is the companies developing new nickel projects who want to demonstrate that they have some of the lowest carbon intensity associated with their nickel product, because they need to show that in order to get offtake agreements with the vehicle manufacturers. So it is quite a substantial driver of interest in what we do, for sure.
Niels, and then Paul.
I guess the question that I have so many questions actually, because I find this topic really, really fascinating. But top of mind is, are companies listening to you? Like, when you come in, when you give them your report and you say you need to do this, you need to reduce your water, you need to, try to go solar, or you need to whatever. Are companies listening to you, or is it more just lip service? Like, I want to know how serious companies are taking their stewardship responsibilities.
Well, I think we have gone through we're going through a transition from what was really greenwashing and companies trying to understand what they needed to do, to a position now where this is being regarded as an engineering and financial problem that has to be addressed, or else the sector will become uninvestable. And that's the reality, because the major financial institutions are all under enormous pressure to show that they're investing their money in companies which are decarbonising. So this is all being driven from that end. And whether you're a believer in man-made climate change or not is now entirely irrelevant if you're a mining company. You simply have to do something, because otherwise big chunks of the market won't invest in you. And I know, for instance, say the gold space is a bit different. A lot of the money at the junior end comes from people who or institutions that maybe don't care too much. But actually, that's changing. You know, we are now talking to some of the big precious metal fund managers who, you know, I won't mention names, but we were slightly surprised that they have engaged with this so genuinely now. And it's not only becoming mainstream, it's becoming essential. And I think the argument is over. The big questions now are, how much is it going to cost to achieve? And before we even get to that point, what technologies are going to be viable? Because although we can easily decarbonize electricity generation now, and the costs of things like wind and solar and hydroelectric and nuclear are very, very competitive, and and in the case of those wind and solar, getting more competitive by the year. The issue is really more about mobile equipment and those big haul trucks and all of the diesel that they consume, and what are we going to replace those with? But already there's some really interesting stuff happening. It's probably going to be hydrogen combined with a fuel cell and a battery. It looks like Anglo American are going to make that work imminently in South Africa at Mogalakwena. And I think from that point onwards, there'll be a real kind of acceleration in the adoption of this technology, because all the major mining companies are, you know, they're all over this stuff now, genuinely.
You used the word greenwashing a moment ago, Mark, and I want to sort of dig a little bit deeper into that. I mean, I think in the past, some people were just putting out whatever it is and say, hey, we're environmentally friendly. Now it seems to be, I won't say sort of deliberate, but a lot of companies have announced their plans to be, you know, carbon neutral or whatever by 2030 or 2040 or whatever their goal or benchmark is. And they've also been signing, you know, PPAs with power utilities all over the place for renewable energy. But the reality is that on any given grid, you know, renewables are part of the supply, but the base load is often coal or diesel or some other carbon-based source of energy. So, I mean, is that greenwashing, or is it they're just not necessarily cognizant of the fact that they're not really telling the truth?
I like the way you asked that question, Paul, because I get a very strong feeling for where you sit on that, but I'm actually a bit more forgiving, if you like, in that I think that there will be a really strong regulatory pressure to show that power purchase agreements are actually underpinned by genuinely low CO2 carbon in most low CO2 electricity in most, you know, jurisdictions. I think there will be scandals. There will be instances where power companies are selling low carbon electricity 3 times over and effectively substituting high carbon electricity on the quiet. But I think there'll be far less of that than you might fear. And so much of the world's mining industry is supplied by grid electricity rather than generating its own. There's going to be tremendous demand. There already is tremendous demand, as you know, all over the world from mining companies of their grid providers to provide them with low carbon electricity, and that it's happening. You know, I think there's certain countries where it's been very slow, very frustrating for the miners, such as South Africa, where everything is still coal-fired, and Eskom having its problems has been very slow to react to that. But elsewhere in the world, I think, you know, this is happening, and it is a real thing. I know it's kind of difficult in that all of those electrons all go into the same grid, and you can't be sure whether this electron came from a wind farm or from a coal-fired power plant. But I think ultimately it will turn out to be a real thing, you know.
Mark, how good a picture can you get of carbon emissions from a company that you don't have access to? They're just not providing it, or you haven't formed a relationship that yet. But it's another company that you probably want to put on the curve. And then I think second would be the question is that do you see this evolving to a state where it would be kind of like financials, where you would have a third party, and then you would have how would you say standards, and accept its industry standards like GAP in terms of how this is actually going to get reported?
It's happening. It's happening under the TCFD guidelines. It's getting written into all of those reporting requirements for public companies all over the world. So it's happening, and that's one of the things that is driving demand for our services, for sure. And I just see that happening day on day. Sorry, what was the rest of the question there, Michael? My mind wandered a little bit. Sorry.
Oh, it just how well you can get an understanding of a company's carbon emissions if you just don't happen to be working with them.
Well, that's one of the things we really enjoy doing, because obviously from our point of view, it's very interesting to come up with an estimate and then try to get a reaction from the company themselves, not by being willfully controversial, but quite often what will happen is we will engage with the company and say, hi guys, we'd be really interested if you could provide us with some more data, and they'll blank us. But when we then go to them and say, okay, you didn't respond, but we came up with this estimate, very often they'll come back to us and they'll start to then engage and say, well, how did you come up with that? And then we hope, and usually are, able to get within plus or minus, say, 10 or 15% anyway, simply because the engineering is the engineering. And if you know a bit about, say, thinking about a gold operation, if you know what the scale of it is, what kind of size of equipment they're using, what the mining method is, a rough idea of the haul distances, what's the altitude. If it's a high altitude operation, it'll be a lot less fuel efficient. If you know a few of those key things, what's the strip ratio, how much waste rock are they mining is a massive driver. And then if you know the ore hardness and the process method, you can figure out how much electricity they're likely to be using. And you'll also get good information from most government reporting in terms of what the grid electricity emission factor is. So you can come up with a pretty good estimate. And I always find that challenging somebody with your own estimate of their numbers is a great way to open a conversation, because they may not even have crunched the numbers themselves. It's maybe something they're meaning to get round to and just haven't yet. But it's worked very well for us, to be honest. And obviously we are always very transparent about to what extent we're estimating and to what extent we're receiving actual numbers from companies. So we do we're very clear about that with our clients. But it's always an interesting conversation.
Niels, you had a question for Mark.
I sort of wanted to go back to greenwashing a little bit, and I feel like maybe we're picking on the mining companies a little bit, but it does, like, part of it feels though like it's like a popularity contest. Like right now, all the focus is on decarbonization and putting up solar panels and reducing diesel. But I mean, like, we don't necessarily really talk about, things like water issues, tailings, all of this other stuff that, so like, a company will, hey, look, we put up, 1 million solar panels and but we have these terrible tailings. How does that all get resolved? Like, it feels like we need to be taking more of a focus on the whole picture, water usage, tailings, all of this stuff. And community relations as well. Yeah,
right. Really great question. And there is already a very, I would say, very imperfect solution being offered to that question. And I'm going to be a bit controversial here, but I'm going to call out the ratings agencies, the guys like TrueCost and Sustainalytics and all of those guys, in that they will provide you with a rating or a set of ratings for a company, and on a scale of whatever, 1 to 5, whether it's good or bad on a whole bunch of those metrics. But the problem is that those metrics tend to be spat out from some kind of black box model. And very often the people producing those ratings they're not necessarily mining sector people. They're not necessarily that familiar with how a mine works. So they can't actually say, well, hold on, does this make sense or not? Because they don't necessarily understand how a mine works. And if you look at the variation in ESG ratings from, say, 4 or 5 of the top ratings agencies for a given company, the variation that they give that company, the ratings that company that they each give, can be massive. So it tells you that something's not quite right about that. And our response to that is, well, the only way you can do it is you have to drill down to the individual asset level. You have to make sure that whatever it is, whether it's energy, CO2, water, tailings, actually you've taken account of the underlying technical drivers and satisfied yourself that it actually reconciles. And then you can aggregate it up into a company number, and you can compare the companies on some kind of ranking, which is what we do. But you can't do it just by taking a bunch of sustainability reports and just scraping all the numbers out of those and then just mashing them together into some kind of rating. It just doesn't work. It gives investors something, and some investors say, well, okay, we know it's not perfect, but it's at least something we can use to answer that question you're asking, Niels. But what we're saying is there's something much better coming, and we're developing it. But to do that, we've got to work our way through a whole bunch of metrics, and water is going to be the next one, and gradually build up that rating from the bottom up. And that's the way to do it, in my opinion. And in terms of what investors and society is interested in, we picked CO2 as our starting point for the reason that we did a bit of an atmospheric test to see. I don't mean literally, I mean in terms of what people were talking about and concerned about, and CO2 was at the top of the list. And next after that is water. These seem to be the things that investors are interested in. Obviously, tailings suddenly leapt to the top of the agenda a couple of years ago when we had the Samarco tailings dam disaster in Brazil, and we had a bunch of investors really engage with that issue and prompt a whole bunch of work by the mining companies to confess what issues they might have lurking in their tailings dams. And I think likewise we've seen a similar blip in interest with regard to cultural heritage sites after the Rio Tinto Yilkens Gorge issue in Australia, where they blew up that that Aboriginal historic monument, and that's pushed that issue up the agenda as well. So it's all kind of bubbling up there, and as I say, our contention is that it all needs to be properly measured at the asset level, and that should be the starting point.
Well, and just like how do you balance? Sorry, I just want a quick follow up. Just like how do you balance it out? Like, a company that has really low carbon footprint but terrible water usage, and okay community relations. Like, what kind of number do they get? Like, where do they fall on the benchmark? Where's someone really great water usage, terrible carbon footprint, and treats communities like dirt? I just like this sounds fascinating to me.
Well, there's ultimately where we're going, I believe, is some kind of environmental cost methodology. And these things already exist. The environmental economists have already created these, and they tend to be quite academic, but it's possible to assign a value to anything. And you can assign a value to water pollution or air pollution. You can do it in terms of the cost to human longevity, or the cost to biodiversity in terms of species loss. And you can assign a dollar value to all of those things. And it's kind of analogous to a carbon tax. We're assigning a dollar value to a ton of carbon. And it's quite possible that things may go that way. It's just that it's quite a difficult, complicated methodology to communicate to the guy on the street. But it does actually stem from something quite interesting, which is this idea that for a long time, humanity has really not been paying the full cost of what it consumes. We are really relying on the planet to absorb all of this unmet cost, and that's going to come back and really cause us problems. And one way to address it is for instance, commodity markets and also the value of anything manufactured or consumed to be rebalanced to cover the costs of either putting the environment right or not damaging it in the first place. And it's arguable that's what we're seeing happening now. It could be we're seeing a big readjustment in commodity prices, partly to offset the cost of increased environmental and social burdens. We're finally waking up to the fact that those need to be paid for somehow. And carbon taxation and all of the stuff that's coming in terms of consumer awareness, it's driving that. So it's really interesting, and it could well lead to a big rebalancing in commodity prices upward, which may be what we were talking about earlier with regard to copper.
Well, I think, Mark, the finance sector is one of the big drivers behind this. So they'll obviously find a way to reflect this in cost of capital and valuation multiples, and the better performers will get the cheaper cost of capital. They'll have the better valuation multiples, and I imagine that's how it will boil down to from that point of view. I think one of the winners out of this decarbonisation paradigm shift is going to be the nuclear sector, because that is a low carbon source of energy. Certainly, if you're listening to the uranium companies, they're very, very bullish about the future. I just wanted to sort of ask you, I mean, it's not one of the minerals you said you cover at the moment, but is all uranium the same in terms of its CO2 footprint? So I imagine some uranium's greener than others from a certain point of view.
That's a really interesting question, because no one really thinks about green uranium. But yeah, there'll be, and I'll be honest, Paul, I haven't quantified uranium in that way. We just haven't looked at uranium yet. But there will be big differences, for instance, between something mined underground in Canada and something that's leached in situ in Kazakhstan. It's going to have a very different energy footprint. But all of that probably is massively offset by the energy generated, the low CO2 energy generated by that uranium when it gets into a reactor. I know there's lots of concern about the other environmental issues around disposing of nuclear waste and the lifetime carbon footprint of a nuclear reactor. But even so, it does seem that yes, the uranium should reap a massive benefit from this ultimately. But of course, nuclear power has always been a very hot potato, as it were, politically, hasn't it?
Yeah. I think the term would be radioactive potato.
Very hot potato, yes.
Let's take it. Yeah. Let's take a different tack, but we have to ask while you're here. Mark, you've done some work comparing crypto and mining emissions.
Yes, I did, and it's a really interesting question actually, because if you look at Bitcoin, and if you assume, say, a Bitcoin value of $50,000. And I know, I mean, there's a fair amount of range on that, as you're probably aware, from minute to minute. Actually, it's pretty volatile for a safe haven asset, I would say. If you look at that in terms of the CO2 emissions, and there's been quite a lot written recently about how much electricity gets used in Bitcoin mining. And the numbers I came up with is that in terms of dollar value, a dollar's worth of Bitcoin, the CO2 emissions from that are around 2.3 kilograms of CO2 per dollar of value of Bitcoin. If you look at gold on the same basis, so a dollar's worth of gold, you'll be emitting 0.5 kilograms of CO2 on average. So if you take all of the formal sector gold mines in the world and add up their carbon emissions, which we do, and divide that by the dollars of revenue created, you get 0.5. So it's a difference of a factor of 5 times thereabouts. So gold is 5 times less carbon intensive per dollar value, if that makes sense to you guys. However, if Bitcoin is going to $200,000, obviously that would actually balance out almost. It provided gold stayed roughly where it is right now. So it's quite an interesting relative value question, and I haven't figured out another way of comparing the two assets, unless you guys have got any bright ideas.
If I was in mining, I would be careful about making that comparison. Crypto's only been around since 2009, and when they had that paper that was produced by Satoshi, and now we're talking about Bitcoins being at 50,000, and you look at the mind share that's captured right now. It's just software. It's just an algorithm. They can design something else. The way that it just happened to be built, and how could you foresee this when you're publishing this paper in 2009, that it would have this much of an impact, and then that you would be consuming this much energy to do that statement of work. These things can be redesigned, and there has been cryptos that have actually been redesigned that you can actually, use far less amounts of energy. There's just different ways of actually configuring these things. If there was some type of regulation on these, you could see that the industry could very quickly come back with a green or an eco type of Bitcoin that you could actually kind of continue to meet this need, because the need is there. And it's a caution, because Bitcoin, cryptos, they can make this turn, I believe, probably very quickly on a dime. Whereas when you're talking about mining, we're certainly more constrained in terms of what our impact is going to be and what it is, despite the work that we're doing right now.
I think that's absolutely spot on, Michael, as a comment. And given the massive potential volatility in the Bitcoin price, and as you say, the potential volatility in its energy intensity, it could shift radically in either direction. Obviously, if the Bitcoin price went down to $10,000, then Bitcoin would be massively more energy intensive than gold on the metrics that we were just talking about. But yeah, absolutely correct. Completely agree with you.
Let's turn to our number of the week. Mark, we always start with the guest. What's your number?
Okay, so my number of the week is that this week, the global mining industry emitted around 30 million tons of carbon dioxide, which is on an annual basis, it's somewhere similar to either Japan or Russia, those country totals. So as it stands right now, the mining industry is ranking equivalent to one of the top 10 economies globally in terms of its CO2 emissions. And the crazy thing is that's going to have to reduce massively and get down to zero over the next few decades using technology which is not yet fully developed at a cost that we don't really know yet. But I'm convinced it's going to happen, and it's going to be a really interesting journey getting there. And that was my number.
How
Paul,
big a
what's your
diamond
number?
would that be?
That would be a pretty huge. That would probably be a diamond the size. Well, I don't know. It'd be the size of a large island, wouldn't it? Really, you could set up an offshore tourist resort on a giant diamond protruding from the sea. That would be.
Paul, your number, please.
Mine's probably, you guys know me, so it's probably an obvious one. $4.71. $4.71 per pound. Copper's broke its all-time high this week. Go copper.
Thank you very much for bringing back the metrics in pounds, Paul. Niels, what's your number of the week?
Paul, I see your copper and I raise you 6.5%. That's the weekly gain on silver this week. Shot up, above $27 an ounce. Nowhere near record highs, but its best weekly gain since December. So that's my number.
Once again, I have to correct Paul and Niels because the actual number of the week is double. Once again, that's double, and that goes back to the major story of this week. The 2020 annual report from CATL, the world's largest battery manufacturer, shows that it sold 47 gigawatts per hour of batteries. That is double from 2018. Once again, that is double from 2018. And that number comes courtesy to us from BMO. That's it for us. Mark, is there any news that we should look for from Skarn over the next 12 months?
Lots more coverage in terms of other ESG issues and lots of forecasting, and hopefully coming up with some interesting stories about how this is all progressing, and hopefully some evidence that mining companies are reducing their carbon footprints. It will happen.
Reach out to us. You can follow me at Michael McCrae. That's McCrae with 2 C's. Niels is at Niels_C. And Paul told us that he has a new Twitter handle. Paul, what is that?
CGS 2021 Gold.
CGS 2021 Gold. Reach out to Paul at that handle. And Mark, how would you like people to get a hold of you?
Visit our website, which is skarnassociates.com. And you'll be able to contact us through that.
If you like what you hear, if you've liked what you've heard, please tell a friend, and don't forget to subscribe through iTunes. As always, your suggestions are welcome. Please reach out and tell us. Mark, thank you very much for your time today.
It's been a great pleasure. Thank you.
You've been listening to Kitco Roundtable. I am your host, Michael McCrae, and on behalf of Paul Harris, Neils Christensen, and Mark Fellows, have a pleasant weekend.